Joining us now is Dennis Silva, Managing Director and Senior Portfolio Manager at Middlefield Group. Thanks so much for making time, Dennis.
Nice to be here, Jacqueline.
So what's your takeaway today? I mean, it seems as though markets were pretty subdued. I know volume is particularly low heading into the Thanksgiving holiday for the U.S., but was there anything new to glean from these minutes?
Well, certainly a perfect environment for releasing Fed minutes going into a Thanksgiving weekend for the U.S. But, I heard you earlier, and I think it was correct in saying, I look at the Fed minutes reconfirming this expectation that the market's kind of built in that we'll see, lower rate hikes. 50 basis points is the expectation for December 14th. I think the part we were hoping to get better clarity on potentially would have been what is that end game? And you said it earlier, I think a higher hill potentially. And I think at this point for the market, that's really the unknown. It's not going to be a surprise if there's a 50 basis point hike, maybe a couple of them. And the terminal rate right now that's being priced in is 5%. But I think that's where the greatest uncertainty is. What is that final ending point before we see that pause, which is probably going to be the next driver for a stronger market, I think, will be between that as well as obviously lower earnings expectations being adjusted over for 2023.
Yeah, when do you think you want that clarity? I mean, I know you want it yesterday, but in terms of what it means for you and your investment strategy going forward, having that sort of uncertainty hanging over you. I mean, we might not know where the Fed intends to end until it's in the rearview mirror.
Yeah, look, clearly we are, whether you want to call it the 8th inning or 7th inning, we're closer to the end than the beginning without a doubt. Whether it's 5% or 5.25%, we're certainly not in a camp that projects 5.5% or 6% by any stretch of the imagination. So we're closer to the end. We're kind of dealing with dueling aspects here. You've got seasonality, which I think people have talked about before, where November to January is the strongest 3 consecutive month period for performance, whether it's the TSX or the S&P. So that's an overlaying factor with the fact that we also are looking for signs of a bottoming being reconfirmed in the market. And that's going to be driven by a number of things, rate hikes, where is the 10 and 2-year yield in terms of have they topped out? What are we looking for with respect to employment levels and signs that is softening, which is one of the things that the Fed is looking for. And I mentioned earlier, we do believe there's going to be further downside to earnings for 2023, maybe about 10% further revisions on the expectation of weaker margins for next year.
You mentioned the seasonality side of things, and we do have a chart of yours showing the average over the last 50 years there for the TSX. We've got the TSX in white and the S&P 500 in blue there for our viewers. So do you think that sort of strength in these winter months is something that's going to hold true this year?
Well, so far, I mean, since the last Fed meeting in early November, I think the S&P is probably up 7%. So far, it's boded well for us. And I think especially for things in my particular neck of the woods, being commodities and especially Canadian equities, I think we're looking for further strength going into December as we see further signs that the market is adjusting earnings expectations for 23. The Fed, hopefully, whether it's on the Fed level or whether it's individual governors and their own meetings and conversations, indicate that they do think they're seeing signs that this rate hike cycle, 4 consecutive 75 basis point hikes, is having the desired impact in slowing down the economy or certain parts of the economy that have been running red hot.
So when you're thinking about Canadian companies, Canadian equities, what sort of areas would you be looking in right now where you see potential over the next year or so, Dennis?
Well, I think Canadian equities in general are very well positioned for what I'll call the return of the old economy, things that are especially commodity driven where Canada excels. So things like energy and agriculture where we're very well regarded, I think will be beneficiaries for years to come. So in the energy space, given the turmoil we expect in the market in the next 3 or 4 months potentially, we like things like Enbridge. It's one of our biggest holdings. It's what I call a holding you could sleep at night very well on, because it is a nice dividend. It's about 6.2%. It's a resilient business model. When you think of the underlying drivers for this company, it moves 20% of U.S. LNG through the Gulf Coast, and that's going to grow. It's well positioned in LNG on the west coast of Canada. It has 98% of its revenue or cash flow bolstered by cost of service contracts or just fixed contracts. So that's very resilient. Inflation factors are well taken care of, again, because they have protectors or levers in their contracts, I think, on 80% of their EBITDA. So it's a great stock to own in this kind of an environment where you collect your dividend and you still have the upside to any strength in underlying commodities.
Another company that you see potential in right now is OCI, the Dutch nitrogen products company. What is it that you like about this one?
Yeah, this one's pretty simple. Our thesis on nitrogen is it is well supported by high gas prices in Europe, because the biggest input cost for nitrogen and its various products is natural gas. So companies like OCI and CF with low cost gas inputs relative to, say, Europe, means that they have very good margins, because on the revenue side, they have a price that's supported by higher gas prices in Europe, but their own internal costs are supported by the fact that in OCI's case, their product is primarily generated in places like the US or in the Middle East or in North Africa, where you have low-cost gas sources.
Dennis, great to get your thoughts today. We appreciate it.
Pleasure, Jacqueline.
That was Dennis De Silva, Managing Director and Senior Portfolio Manager at Middlefield Group.